Hello, everyone, and welcome to another session. This is Dibyosh from Immaticus Learning. Today, I will be discussing a topic which is there in ACCA at both FR level and SBR level, CPA, FAR, and CMA US. So basically, wherever you study accounting, this is there. Slight variations here and there in IFRS and GAAP because ACCA follows IFRS 9, CPA follows GAAP. Slight variation, but more or less it's same. So what is the topic? Accounting for investment in debt securities or debt instruments. So here we are talking about when you have made an investment in debt instruments. So what are debt instruments? Generally, either bonds, can be loan or any other notes issued by the company, or redeemable preference shares. So first, this is more focused on IFRS 9. So that is what I am following. For slight differences, we'll discuss that at the end of the series. So first, fair value through profit or loss. IFRS 9 says there are three ways through which an accounting for investment in debt securities can be done. FVPL, that is fair value through profit or loss, amortized cost, or fair value through other comprehensive income, that is FVOCI. First, fair value through profit or loss. Now, this is the default category for bond investments. So IFRS 9 says that this is the default category for all bond investments. Means unless they fulfill the criteria of being recognized in amortized cost or fair value through other comprehensive income, by default, they will end up in FVPL. Now, what are the rules? First, generally we say these are those securities which are purchased by the management with the intention of reselling them in the very near future. That is the general characteristics, little bit practical perspective I'm giving you. That this is what we generally say, that the intention of the management is to resell them at a very near future. And the objective is to benefit from the price increase. So those securities generally fall under this FVPL, both in IFRS and in GAAP. Now, what is the rule? First of all, accounting rule says any transaction cost associated with the purchase of these investments are expensed to SOPL, profit and loss account. So if you have paid any brokerage or any other charges practically to purchase these securities, you cannot capitalize it and take it to balance sheet. No, you will have to immediately expense it in the profit and loss account. They will not be included in the initial value of the asset, means they will not be capitalized. Now, what does the rule again say? That at every year end, so at each balance sheet date, investments will be revalued to fair value. So on each balance sheet date, your investments have to be measured to fair value. This is called mark to market, generally for listed securities. And any gain or loss, see, this is unrealized gain or loss because you have still not sold the security. You are holding it on balance sheet date. So any unrealized gain or loss will be directly again reported in the profit and loss account. Now, let's just summarize what we have studied. FVPL. First, this method says this is the default category for bond investments. So unless they fulfill the criteria to be recognized as amortized cost or FVOCI, by default they will go here only. Second, any transaction cost, brokerage, STT, anything that you have incurred to buy these securities, they will be expensed in the profit and loss account as and when incurred. They cannot be capitalized in the balance sheet. And These investments will be revalued to fair value at each year end. So at every balance sheet date, the investments have to be revalued to fair value, market value. And any unrealized gain or loss, why unrealized? Because you still hold the instrument with you. That will be recorded in profit and loss account. I hope you are clear till here. So let's look at an example that I have prepared for this. Example 1. On 1st October, please read it with me and read it patiently. On 1st October 2002, X Limited purchased 1000 bonds. So on 1st of October 2002, X Limited purchased 1000 bonds at a cost of $945,000. So on 1st of October, X Limited, a company, purchased 1000 bonds and the cost was $945,000. The company incurred acquisition cost. We just discussed transaction cost. That is also called acquisition cost. I have intentionally put this language so that you get familiar with the exam terminology. The company incurred acquisition cost, that is transaction cost of $1,100 for the purchase of the same. The market value of the bonds as on 31st of December 2002, balance sheet date, unless told otherwise, we generally assume year end is the balance sheet date, was $968,000. Value has gone up 23,000. Finally, the company sold the securities on 2nd of February 2003, next year, for $956,000. What have I asked here? Past journal entries in the books of X Limited. Now, if you are a slow student like me, you need some time to process all this information. So let's process it again slowly. On 1st of October 2002, so first transaction date, 2002, X Limited purchased 1000 bonds and the total cost incurred was $945,000. The company also incurred acquisition cost, transaction cost of $1,100 for the purchase of the same. The market value of the bonds as on 31st of December 2002, that is balance sheet date, was 968. So by balance sheet date, I have not sold this and the value has gone up. The company sold the securities on 2nd of Feb 2003, next year, for $956,000. Past journal entries in the books of X Limited. Now, let's just recap the rules. First, the rule says any transaction cost associated with the acquisition of these securities will be expensed to P&L immediately. So this $1,100, the transaction cost, this will be written off in P&L. It is not going to balance sheet. Second, the rule says at every balance sheet date, that is 31st of December, the asset will be required to be revalued to fair value, that is market value, which is $968,000. And then final entry will be passed next year when the asset was sold on 2nd of Feb. So see, in the books of X Limited, first entry passed on the date of 1st of October 2002. First, you pass an entry for recording the acquisition. So investment in bonds, debit, cash, credit, $945,000. Here, I have recorded the acquisition of bonds. Both are balance sheet items. This will increase asset and this will decrease asset in my balance sheet. Now, one more entry will be passed on this date itself. The entry for transaction cost or acquisition cost. We just said that transaction cost as and when expense should be written off in P&L account immediately. So here the transaction cost is $1,100, see, for the purchase of these. So we have to immediately write it off in P&L. So transaction cost debit, cash credit $1,100. This is an expense will be written off in P&L or SOPL for ACCA students as they call. And this will reduce your asset in the balance sheet. Now many students, if you are asked to present journal entries, instead of doing transaction cost, you directly debit P&L account. You will get most likely marks for it, but technically it's not correct. You need to understand also how the actual accounting works. P&L is not a ledger. Only a ledger can be debited or credited. It's a statement where you are compiling or closing of the ledgers generally. So ideally transaction cost will be a separate ledger which will be closed off in P&L. So transaction cost ideally should be debited separately. Otherwise no problem. You'll get marks for it as well. Now on the balance sheet date, 31st of December. So see, for 1st of October, I am a slow student. I am assuming you guys had to, so I will go as slow as possible. On 1st of October 2002, the company purchased 1,000 bonds at a cost of 945. So I have done the accounting for this. See, investment in bonds debit, cash credit. And the company incurred acquisition cost, which I have expensed in the P&L immediately. So first part. Second part of accounting says at every balance sheet date, I have to revalue it to fair value or market value. So market value of the bonds on 31st of December 2002 balance sheet date was 968. Now see, my original acquisition price or capitalization value was 945. And this has increased in the balance sheet date to 968. So I have to make sure that on the balance sheet date, the investment is worth 968,000 in the balance sheet. How do I do it? It's an asset account. I debit it. So the balance increases 23,000. The balance automatically increases. Now 945 it was, you debit it. The balance further goes up 968. If you want to reduce an asset account, credit it. And again, credit many of you will directly do to P&L, but ideally it should be to a separate account, unrealized gains. This will of course go to P&L only. It's not like it will have a separate treatment. Nah. It will go to P&L only. So you can credit P&L. Now the final transaction. The company sold the securities on 2nd of Feb 2003 for 956,000. Okay, so date here is wrong. It should be 2nd of Feb and it should be 2003. So company sold it for 956. So cash debit 956 because this is the money I am going to get. Of course, I have to credit the investment now. Now remember, the moment you marked the asset to market value on the previous balance sheet date, that has become the new carrying value of the asset in the balance sheet. So asset will now not be recorded at 956. The value has become 968. So 968 past credit. And difference is a loss, realized loss. Because now you have sold the security, so it's no longer unrealized, it's realized. Now, if you understand, gain on any security should be sale price minus purchase price. Correct, no? In this case also, the sale price final is 956 and the, sorry, 956, yes. And the purchase price was 945. So final profit should have been 11 only. It is 11 only. See, in one balance sheet or one P&L account, you credited 23, calling it unrealized profit. And in another one, you debited a loss, calling it realized loss. Why then to do it? Because these are in most of the cases, these are heavily liquid securities and the value can drop drastically. You will have to learn more about in the finance, but for true and fair presentation, this is accurate. This is the true picture. So this is what we call as FVPL. Let's recap for final time before I move to amortized cost. First, any transaction cost expense to P&L, and this is the default category. Second, at each balance sheet date, the asset has to be measured to fair value. And all the unrealized gains or losses will be recorded in P&L. And remember, the new or the fair value of that date becomes the new value of the asset in the balance sheet. So I hope we are clear till here, right? Hi everyone. It was getting in the part two of this. We are going to discuss about amortized cost. Now, IFRS and GAAP both allow you to classify an investment in a debt security as amortized cost. Amortized cost means you will carry the instrument or security on a cost basis. It has nothing to do with fair value or market value at all. So generally, IFRS 9 says for an instrument to be carried at amortized cost, the two tests to be passed are as follows. First, business model test means entity must have the intention to hold it till maturity. And second, contractual cash flow test. That means the security is such that cash flow will only have two components, principal and interest. Now just remember, if a debt instrument is held at amortized cost, the interest income, because for the company it's a liability borrower, for an investor it's an income. It will also be calculated using effective interest method, and that will be taken to SOPL. And cash received is generally reduced from the asset in the balance sheet. So this is the table we will follow. And effectively same table is followed in bonds payable as well. So you have opening balance, that is balance brought forward. You have interest income. Remember, this is your SOPL item. This will go to your SOPL each year. That is statement of profit and loss account. Payment received. This reduces the carrying value of the asset and balance carried forward. So see opening balance, SOPL, that is interest income, it increases the balance of the asset. Payment received, it decreases, and closing balance. Now remember, interest income, how will it be calculated? It's always no exception to this rule. Opening balance, whenever there is effective interest method, this will only apply. So it's opening balance. Opening balance, I have written from a layman's perspective. Otherwise, it's immediately preceding carrying value. Just when you are calculating interest, you multiply that with effective rate of interest. This will be given in the question. Remember, never multiply it with coupon rate or stated rate. You always have to multiply it with effective rate of interest or market rate of interest given in the question. For calculating cash received, note 2, I can write it actually. So cash received will actually be the face value or par value or the price, and that will be multiplied with coupon rate or stated rate. That is cash received because contractual payment will be as per the agreement. That is whatever was the face value or par value multiplied with coupon rate. But Interest income, that is what will be recorded as income in the P&L account, will always be opening balance, that is immediately preceding carrying value into effective rate of interest. Now I have a question for you. This is the last question. That's it for this session, because I know FVOCI is pending, that I will cover in another session, because this part is more or less same in both GAAP and IFRS. And remember, one more part of accounting. Any acquisition cost, transaction cost incurred to acquire these securities, they will also be capitalized. Any acquisition cost incurred. Remember in FVPL, fair value through profit or loss, we expensed it, wrote it off in profit and loss account. But here we will bring it to balance sheet. And it will be written off on an amortized cost basis. On 1st January 2005, Bland bought a $10,000 6% bond. So $10,000 is the face value. 6% is the coupon rate or stated interest. And at what price they bought? Acquisition cost 9,000. Incurring acquisition cost of 144. So they also incurred acquisition cost of 144. And of course, this is amortized cost. So it has to be taken to balance sheet, capitalized, not written off in P&L. Interest is received annually. So interest is received once in the year. In arrears, arrears means at the end of the year. And bond will be redeemed at a premium of 500 over its nominal value or face value. So nominal value is 10,000, you will pay 10,500. On when? 31st of December 2007. So 1st January 2005, this is the date you purchased the bond, and it will be redeemed 5, 6, 7, 3 years later, not 2 years, 3 years later, for 500 premium on 31st of December 2007. Effective rate of interest is also given, 11%. Now they have given you the fair value, that is market value of the bond on 31st of December 2005, first balance sheet date, 11,000. Second balance sheet date, 10,400. Show how the bond will be accounted for over the 3-year period if planned to hold the bond until the redemption date. Means amortized cost. The intention is to hold the bond till maturity date, business model, and let's say the cash flow characteristics is also met. When you are writing the answer, you will have to write that business model test met, cash flow characteristics, assuming it is only principal and interest which is provided, met. Now you can start your answer. Are we clear till here? So if you guys see, you have same table, opening balance, interest income, payment received, closing balance. First of all, let's do it year by year. So let me take you to an Excel tab. 2005, first year, 2006, second year, and 2007, final third year. Now, read the question patiently with me. On 1st of January 2005, Bland bought a 10,000, that's the nominal value, 6%, that's the interest rate, for 9,000. So this is the purchase price, acquisition price. And they incurred acquisition cost of 144. Remember, this is held to maturity or amortized cost, because business model, and in GAAP we call it HTM, held to maturity. Here we can call it amortized cost. CPA students or CMA, earlier one in GAAP is called held for trading. Here we call it fair value profit loss. This is held to maturity or FVPL. Focus is right now on ACCA only. So 9,000 incurring acquisition cost of 144. So both will go to balance sheet. So initially on 1st of January 2005, the entire transaction cost, that is 9,000, that is the purchase price, and 144, that is the transaction cost, both will be reported in the opening carrying value, that is, will be capitalized and taken to balance sheet. Now remember, 6% is the coupon rate or stated interest rate, and effective interest rate is 11%. And I told you, if you look just at the preceding page, that interest income in this amortized cost basis, same as in bonds payable, there it is interest expense, is always opening balance, that is preceding carrying value, multiplied by effective rate of interest, not coupon rate. So in this case, what should I record as interest expense in the first year? The opening carrying value, that is 9144, multiplied with effective rate of interest. So it will be 1005.84. So I'm rounding it off. 1006. It's a pivot table, so it's coming. Cash received. Remember, I just taught you. Cash received is always par value or nominal value into coupon rate. It has nothing to do with effective rate. So on 1st January, Bland bought a 10,000 nominal rate, 6% coupon rate. So cash received every year will be same, 10,000 into 6%. So cash received is one thing which will not change. Every year it's same only. 10,000 into 6%. So it will be 600 every year. Now, what is the closing carrying balance? Remember, I told you opening balance plus interest income minus cash received. Opening balance plus interest income minus C 600 cash received 9550. Now, next year, the opening balance becomes 9550 in 2006. This was all 2005. First, the transaction was recorded at acquisition cost and also at the transaction cost. Then interest income. This is the income that will be reported in P&L for the investor, not the cash received. This was reported based on opening carrying value into effective rate of interest and then cash received, which reduced the carrying value of the asset. 9550. Second year, carried forward 9550. So second year, 2006, opening there is no entry, but for interest, 9550 into 11%. I'm doing it here only. 9550 into 11%. What is it coming? 1051. Minus again same 600. See, it's automatically taking the formula 10,000. Ideally, it should be 10,000. I'll explain you the rounding off. Next year, opening balance again 10,000. What will be interest income? Yes, 10,000 into 11%. That is 1100. Minus again every time same 600. Now see, you have the table complete 10,500, which is the maturity value that you have to pay. Shall we pass the journal entry for this? Yes. So what is it? See, 2005 opening value, interest income, cash received, closing. 2006 opening, interest income, cash received, closing. And 2007 also same. I know journal entry is not required for the purpose of your exams, but you should still know it. Why so? Because journal entry is more or less the soul of accounts and you will find journal entries. So I'm explaining it to you, not forcibly, explaining. So first, on 1st of January 2005, investment. Remember, investment in bonds debit. Here, both 9,000 and 144 will come. See, in this tab, 9,000 and 144. So both will arrive here. 9144. Cash, credit. Both are balance sheet items. Second, Interest income. Now this is what goes to, or this is what is actually reported in P&L as an income. So it is an income for the investor, right? So interest income. Now this though makes your job easy. Interest income on 31st of December. That is 1006 in the first year. Second, 1006 only now. Huh. Now what should I debit? Have I received cash? No. It will increase the carrying value of the bonds. Investment in bonds, debit 1006. That is how the bonds value is increasing, and that's why we are adding it in this table. See, that's why I am adding it in this table, because the asset is increasing in value. For me, it's an asset, I'm an investor. For company, borrower, it's a liability. And third, cash debit, which the money they have actually received. And of course, you have to reduce the value of the asset. You have to reduce the value of the asset. So closing you reach 9550. See, books don't have tables. Books means books of accounts. In books, you are passing entries, and finally the balance directly gets plugged into trial balance. So you should understand how the accounts are moving. Next year, opening entry is not required, only two entries. First, for interest, same thing. That's why I'm adding it, because it is increasing the carrying value. So investment in bonds, debit. What was the interest amount? 1050. Please always understand the journal entries, because ultimately you have to work, right? Interest income credit 1050. And of course, cash received will be same only. See, books are automatically adjusting plus minus. In table, your life is easy, and most likely they will not ask journal entries, but you should know. And last year, see, first, of course, investment. Here, three entries will be passed. Investment in bonds debit 1100. Sorry. Interest income. This is the income that will be reported in your P&L 1100. Cash balance sheet and value reduced of investment in bonds. Now what has happened? See, in the table also, everything is done for 3 years, if they ask also. In the table also, you are staring at 10,500. See this question. On 1st January 2005, Bland bought a 10,000 6% bond for 9,000, incurring acquisition cost of 144. Interest is received annually in arrears at the end of the year, and the bond will be redeemed at a premium of 500. I will get 500 extra. So see, I am at the correct phase. I just need to pass final entry now when I'll get the money. Cash debit as an investor, I will get 10,500, and I will remove the asset from the books because I have received the money. 10,000. Done. Books are clear. No asset and nothing. This is how accounting works. I hope you guys understood it. If you did, like, subscribe, and comment on the video. Further, we at Imaticus Learning are committed to help you. And for ACCA, CA, CMA, CP, and all kinds of courses, this is the contact number you can use to reach out to us, and we will arrange individual counseling for you that is suitable. So this is the contact number you can use to reach out to us, WhatsApp or call, and we will arrange counseling for you to for your necessary requires, both online and offline. So thank you everyone. Have a good day. Goodbye. In the next session, I will cover FVOCI.